role. But maybe a little bit of background to this session, because I'm very excited about it, because we do have, I think, the 4 leaders across the rural service, animal feed and input space. And I think it's a mark of the maturity of this industry that they are able to all speak in the same panel discussion beside each other. There's a few sectors or subsectors within ag that are very hard to get on the one panel, and this is not one of them. And certainly the last 5 to 10 years that I've been associated with the sector, it's been lifting to this sort of level where you can have these meaningful discussions, and it becomes, it lowers the risk, I think, to invest in the sector when you do have leaders that can speak to each other and be quite comfortable helping out each other at an industry level, and showing the investors that they are very comfortable being in each other's company, and also for the goal of competitors aren't here in Australia, the competitors are offshore. Okay, are we right to go? We might get Adrian to introduce himself. His presentation will pop up quickly, but we're very happy to have Adrian Capogreco. He's been a supporter of our conference for a number of years, and he's risen to the top. So obviously one of the key reasons why he rose to the top was coming along to our conference. So hence he's going to be here for life. So thank you very much, Adrian. Look forward to hearing what you have to say.
Thank you, Paul. I'll let you guys get the slides up and running. But yeah, a bit of pressure, Paul, being moved to first on the queue. It's a bit of pressure to keep you on time. I think that will be the biggest risk that I run. But yeah, great to be back. And yeah, you could be right there, Paul. Perhaps I spoke at this conference 12 months ago, and it was an excellent conference. You guys do a great job, as always. So thanks for having me back. But yeah, perhaps you are the secret to the success. So I spoke as the CFO of Nutrien 12 months ago, and speaking to you today as the managing director. So I was appointed not too long ago. Thank you. Thanks, guys. Okay. So yeah, it's a real privilege. It's a real privilege to be back. As I said, good to see some familiar faces. I know some of you, for those that don't know me, Adrian Capogreco, Managing Director of Nutrien here in Australia, been in the role only a number of weeks actually, so but great to be back. Hey, it's a privilege also to speak at these conferences. It's good to be in front of you guys and sharing ideas, sharing challenges, sharing opportunities, understanding a little bit about the market dynamics that we're facing, where we are in the cycle in particular. It's an excellent theme actually, sustainable growth through cycles. And obviously we're all looking for ways to create value in the sustainability space. We're looking for the value pools that are going to bring themselves to market. We're looking to access new markets. We're looking to access capital. There's all those good things. But then there's the element that they've inserted into the theme around cycles. And they're also really important as well. And that's probably what I'll spend a little bit of time on today as well. Where are we at in the cycle? Where do we think the cycle's going to go? How do we position ourselves to operate through those cycles and serve our customers? These are the things that we think about, and I'm sure you all do as well. So I'm going to talk a little bit. I'll orientate you to the Nutrien business globally firstly. I'll spend a little bit of time on that. I'll get to the Australian business, of course, which some of you are familiar with. But then in particular, I want to get to just some of the data and insights that we're seeing at the moment. And to that point around cycles, some of the things that we're seeing and some of the things that we're responding to position our business to be really agile and be able to respond to some of these potential movements in the cycle in the period ahead. Which is working good. Okay, so first of all, Nutrien globally. So we are a leading global agricultural solutions provider. We are one of the biggest fertilizer producers in the world, number 1 globally in terms of potash, number 3 by nitrogen. And we pivot that into a retail footprint that is also number 1 around the world. So we operate in some of the most important agricultural geographies in the world, throughout the United States, Canada, throughout South America, particularly Brazil. And I'm really proud to say Australia as well. It's one of the most important geographies that we operate in. And it's a geography that we see as a real growth market. So we look at these geographies and we say, Are they attractive for capital? Are they stable? Are they going to be growing, prosperous, innovative agricultural markets? And again, really proud to be able to say that Australia absolutely is one of those. And so we operate throughout the value chain in agriculture. So if we go all the way back to upstream through midstream and downstream, I'll talk a little bit about that. But first of all, just to point out that in the production of NPK, we really do look for pockets of value in the entire value chain. We look for areas where we can play a role, where we can invest, where we can bring efficiency, where we can bring capital, where we can bring innovation, and most importantly, where we can add value. If we're not doing that, and this is the lens we look through, we're not adding value in what we're doing in the value chain, then we look at it through the lens of we're just simply adding costs. So we're very picky and choosy around the roles we play in the value chain, where we choose to invest, and the role that we do play. So production assets, obviously around potash being the predominant market, nitrogen and phosphates as well. And then through the supply chain, so through the midstream, which is increasingly becoming important. And supply chain will be a theme that I touch on briefly as I go through. But the role we play in the supply chain is varied. There's opportunities to collaborate on some of the most important infrastructure that operates throughout the world. That includes Australia. And there's also opportunities at times to invest in and own that infrastructure. And again, we'll pick and choose our moments where we think we can bring efficiency to market by playing that role. And then there's the role we play in Australia and several other markets that I mentioned, which is around the retail network and our ability to vertically integrate into our retail footprint. And as I said, we've got that really strong footprint, #1 player in the world, throughout the US, throughout Canada, throughout Brazil, and of course, Australia. So let me zoom in a little bit on Australia. We have a very diverse business here in Australia. We have a national footprint. It's a business that we're really proud of. We've got 4,000 odd employees scattered around the country that are positioned to serve our customers. Within that, we've got about 400 agronomists that are specifically there to serve customers and help them get the most productive outcomes they can. Beyond that, we've got 700 odd locations throughout the country. We've got multiple touch points in many different ways, whether it be bricks and mortar retail stores, whether it be depots, whether it be distribution centres, whether it be office spaces, whatever the case may be. We're positioned around the country to support customers and really to support agriculture throughout this country. We've also got a range of independent members that we sell through. That wholesale channel is really important again to provide options to customers and to provide fluid supply. And then, of course, as I said, there are at times opportunities to play a role in the supply chain and add value, efficiency to that. And one of the ways we do that is by having a degree of manufacturing, in particular formulation capacity. And we've got that both now on the West Coast and on the East Coast. We expect to have more formulation capacity coming online right here in Melbourne in the coming months, which we're really excited about as well. Then in terms of the way that we go to market and the way we think about strategy, and again, the cycles will influence this a little bit, but what I am pleased to say is globally, the way we think about strategy in Australia in particular, it is really consistent. If you were here last year, you'll probably hear some of the same things that I said last year around the way we think about go to market. But those strategic priorities really are consistent, they're unchanged, and that flow of capital really is fluid. So whether that's business model optimization and the way we can bring the most efficient model organised around the market, organised around customers, we're really focused on that. Allocating capital to high value investments. I'm always really pleased to say that Australia holds its own in terms of having really compelling cases for capital, and we're frequently able to access capital in a global organisation against all the other competing geographies. We're able to put up good cases to deploy capital here in Australia, and we'll continue to do so. Innovation is another big thing that we think we can really add value to in the marketplace. We're particularly excited about some of the products and portfolio that we already have at market and we bring to market and commercialise soon around plant nutrition, soil health, and some of the options that will bring to our clientele here in Australia. Digital as well, whether we can use digital to, and we are certainly investing in this, and I spoke about this last year as well, investing in digital, looking to bring efficiencies to market in particular, but there are going to be really good, efficient ways to engage with our customers and digitise aspects of that customer experience. So we'll continue to look for opportunities to do that where it makes sense. And also generating value through commercial sustainability. And it's just that. It's what I mentioned earlier, the ability to access new markets for our customers, the ability to access capital, and again, hopefully being at the forefront of some of the value pools that we think will be created in this space in the years ahead. So money going in this year, and again, we're really excited about the way we're going to deploy capital in 2025, but we've got some really good initiatives that we think will bring value. So agile and robust supply chains is really a catch cry that we have internally. It's an area that we will continue to deploy capital to. We think that's a big risk, frankly, in Australia, the way that supply chains function. They're reasonably fluid at the moment, but as we get to some of the data points that I'll talk to shortly, they are a very fragile thing, and disruption is likely. It's happened before, it'll happen again, and being as ready as we can will serve our customers best. Again, investing in sustainable products will be something that products and solutions, I should say, will be another feature. Investing in our agronomy network, again, this is something that's at the forefront of our business, serving customers, helping them get the most productive outcomes we can. It'll be something that we really put a focus on investing in this year in particular, but also going forward. And then the final thing I'll mention, I could probably rattle off these to a greater number, but the other one that I think is really important in the market at the moment is liquidity and working capital. So we've got a suite of financial products that we provide to our customers. We're really proud of those. We'll continue to bring those to market. And we think they're going to be really important for our customers to be able to access the liquidity they need to capture market opportunities as they arise in the market. So we'll continue to invest there. All right, so I might get into a little bit of the data points. As I said, there's a range of data points that we look at regularly throughout cycles, and there's different information that will come to our hands that we see, that we're able to generate insights from, that we're able to share, that are able to bring to account in the way we go to market, the way we tactically strategize to position our business through different phases of the cycle. So I'll share a little bit with you around some of the things that we look at. Obviously, one of the first things to start with is sentiment. Sentiment's always really important. I was actually, the last 3 days I spent in northern New South Wales and the Darling Downs, just travelling around, visiting some of our network, and I would say it was a mixed bag. Sentiment was generally good. It was pretty flat though. They expected a little more from the rain system that just swept through, and it was a little patchy, as many of you guys would have seen, and I think frankly a little underwhelming in most parts. But that's pretty short term. Long term, there is really positive sentiment. There's sentiment around soil moisture, subsoil moisture that we think will be good for the short term. There's good sentiment around commodity pricing. There's good sentiment around farming costs coming down. So we look at it through a number of lenses. Looking through a macroeconomic lens, economic growth probably likely to be fairly subdued in Australia. But one of the things, again, that gives us confidence is the fact that the key ag export markets for Australia that are really relevant for Australia, they're going to grow both population-wise and in real wages terms as well. So we think that will play into our advantage. Agricultural production will still be at above average levels. I think we've all seen that. We've seen the ABARES data, so that's a positive. I think they quoted $91 billion in ag production for 25-26, which again will be pretty steady year on year and above the long-term average. So we're pretty upbeat about that as well. Livestock's another one. There's a bit of a mixed bag on livestock, really. And as some of you guys will know, real differences emerging between beef and sheep at the moment. We think beef markets are underpinned by some pretty strong fundamentals at the moment, and there is investment going in to Australia, which is really encouraging. I saw firsthand last couple of days investment in feedlots and other infrastructure throughout the value chain, and particularly for grain-fed cattle, there's just a real emerging market for that will just continue to get stronger, we think. So there's a number of fundamentals that support that. You guys will be familiar with it. Obviously, the herd size in the US is depleted. That will play a role. Tariffs are there, obviously, and the role they play is yet to be seen. But as yet, that appears to be noise, and the Australian market's reasonably fluid and underpinned by strong demand. Also, other factors, whether it be Canada or New Zealand production being a little lower, there's a bunch of fundamentals that play into a really strong beef sentiment at the moment. Sheep, a little bit different. Obviously, numbers down, the merino herd down. Western Australia probably leading that. I think the latest sort of sentiment survey I saw there, 50% of farming operations in Western Australia planning to downsize their crop, which again is not unsurprising. There's some aspects there around live sheep exports and really robust cropping conditions. So you're going to continue to see a bit of a pivot to that. Overall, there's challenges, but I think they're outweighed by some terrific opportunities in the market. So we're going to continue to see those. Another thing we look at a macro level that informs us a little really is around global grain stocks. So grain stock to use in particular. And we find this really interesting. It's sort of trending down. It's actually at its lowest levels now since 1996, 97. So a long time ago through that lens. So I think generally this is good news. Generally this is good news for commodity prices. We think demand will continue to outstrip supply. But I guess the other insight from this is this dynamic is really sensitive to changes in the market. So if global supply chains suddenly don't function properly, or there is disruption, geopolitical or macroeconomic disruption, then we think this will be one of the indicators that will play out. Another one is commodity prices. So I couldn't get through a data presentation without highlighting the charts from 2022, 23. Really, commodity prices were incredibly volatile through those years. So thankfully, they've come back a little bit. But this really is an area to watch. So whether it's input prices, whether it's output prices, the volatility has been pretty extreme through recent years. I think the fact that it's come back and stabilised is good news for farmers. But again, the way that global supply chains function, the way that free trade functions could have a big bearing on the way these statistics look 6 months from now, 12 months from now. Another one that we watch really closely is Chinese export restrictions, so particularly around fertiliser. So we've seen for a number of years now that the Chinese market is prioritising fertiliser supply for its own domestic market, and we've seen that. They're continuing to restrict in different ways, but they do have significant power to shape demand and supply variables in the market. And 2024 was no exception. The concept of Chinese export restrictions wasn't new, but again, further restrictions around AP phosphates, which was really important. So Australia actually got through it just fine. We ended up sourcing from the market, mainly sourced from Morocco, and was able to pivot in a fairly fluid way. But even still, it was a fairly significant shift for global supply chains. So urea as well, the other one to watch. The predominant supply for Australia at the moment is actually out of the Middle East. And we expect that will be the same for the foreseeable future. So I guess the point here really is we've got this dependency on markets like China. We've got dependency on markets like the Middle East, which, we've got an environment where supply is reasonably fluid at the moment, but these are markets that are very easily influenced by shocks, by supply chain disruptions, by free trade changes in settings and policy settings by those governments. So it really will be an area to continue to watch. Another one is inventories. So again, something we watch really closely is what is happening with global inventories. And so I'll zoom in on this one in particular, nitrogen. Australia being predominantly a nitrogen market, this is one particularly that we look at. Inventory levels, particularly in the US market, which is a bit of a barometer, they're down. So they're below average. UAN and urea pricing reasonably stable at the moment, which is a good thing. But again, these are subject to change. Australia is well supplied, I'm pleased to say, and hopefully that will be the case for the season ahead. I expect it will be. But 2024, we saw record imports of nitrogen into the Australian market, which makes sense. Big crop, a lot of nutrients pulled out of the ground that need to be replaced. And I think it'll be the same in 2025 and hopefully for the foreseeable future in terms of the productivity. But the dependency on nitrogen into the Australian market will continue to be really important. So this will be an area that we look at. And then I'll wrap all of that up with all the things that are through the news cycle every day and the things that we talk about and the things that we try to strategize around. And that is some of these geopolitical uncertainties that we work through. And these will all be familiar to you. And I'm not going to be able to crack the code on these things, but We do think about them at Nutrien. I know you think about them in your businesses as well. How do we respond to these things? How do we position the Australian marketplace to be resilient and agile? How do we position our businesses to have the best chance of serving our customers through the cycle? So these things, whether it's the Russia-Ukraine war, and we're all looking for what happens with fertiliser and grain supply chains there, whether it be Middle East conflicts and the capacity to disrupt the way the global supply chains function, particularly logistics costs as well will be a big factor. US trade policies, so everyone's talking about that at the moment. So how do those trade flows function in and out of the United States? And I guess other subplots to watch for there are energy policies and policies and sustainability policies, which we're all very interested in as well. The Chinese economy will be a big one. Everyone's talking about this as well. So how robust and resilient can that economy be through the scrutiny of these tariff wars? If their economy starts to stutter, then it's almost inevitable that ours will as well. China, and as I've also mentioned, will have a big bearing on the way that crop prices are positioned in the market, the way that fertiliser and other input are positioned. So really, really important as well. And then you can come all the way back home to the Australian election as well, which is probably slightly less interesting than some of those other things, but still, it's going to be relevant. There's no big major, productivity or economic reforms that are likely to play out for our industry anyway in the short term. But certainly there are things to watch for, whether it be the position on live sheep exports, whether it be environmental and energy policies, whether it be management of inflation, of course. There'll be a number of things to watch for. So we'll see how that plays out as well. There are many variables. We're all in the same boat, but positioning ourselves and positioning our customers to be as resilient as possible will be a focus for us, as I'm sure it is for you. And then I'll finish with this, which is zooming right back into Australia, but this is something that we're really proud of. So I wanted to quickly mention it as well, which is the investment that we make in our communities, the communities in which we operate, the rural and regional communities that we're so proud to operate within. So it is a real privilege to operate in those communities. We really want to build where we have the opportunity, well-being and resilience in these communities, and we're looking for avenues to connect as best we can and give back to those communities. So we do that at a grassroots level, and we empower our bricks and mortar branches, our network to make appropriate investments in those local markets, whether it's through local sporting clubs, agriculture shows, community grants, grassroots initiatives. We're really proud of those. And then at a national level, and this is more what you're seeing on the screen here, a range of partnerships that we think make a real difference in these communities. And there's a number of things that we're doing, whether it's community grants program that's been really successful for a number of years now, whether it's the CRT primary schools program, whether it's the care flight emergency trauma training that we're offering throughout these communities. It's been a real privilege to do this. We spend roughly $3 million a year doing this, and we'll continue to do that. In 2025, we're actually adding to this list. So we've got the Primary Industries Education Foundation Australia to develop sustainable agriculture resources for high school educators across Australia. So you'll hear more about that very soon. We're very proud of that. We'll continue to look for opportunities to add to this. And as I said, it's a real privilege to operate in these communities and look for opportunities to give back. So with that, Paul, hopefully that was okay for first up. I'll leave it there. Thank you very much.
We've got a couple of roving mics with James Wilson over there and Joe May. If there's any questions for Adrian? There are. Andrew in the middle there.
Adrian, thanks for the presentation. You've got a unique perspective on global ag and the investment world. How does Nutrien sort of look at Australia? You've got obviously 20-25% market share in North America. You're strong in South America. Europe is a gap. You're 40% in Australia. But just talk to us about how you think about allocating capital and how Australia looks from your global perspective.
Yeah, no, great question. And look, I'm proud to say it stacks up. That's the simple thing. Like, there's a few features of the Australian market that make a lot of sense and that a global player will like about the Australian market, and we're big promoters of that. So there's the innovation that occurs here. So what our farmers are able to do with less is incredible. And when you bring folks from overseas through, and tour some of the operations that we have here, they are truly mind blowing. What we're able to do with such minimal moisture, what we're able to do with land in terms of both sustaining the land but getting productivity out of the land, just incredible. So innovation and adaptability is one real important thing. There's a degree of resilience in the market. There's a degree of stability. So obviously, if you're going to look at the Australian market, there is stability here. It's a good place to invest. We also invest in other pockets of the world like Brazil, but you're going to demand a different return profile in a market like that. It's riskier. There's more instability. So yeah, there's features around the stability, the innovation, the resilience. And actually, for a global company like us that has a range of, I mentioned briefly the plant nutrition and some of the soil nutrition products that we've got. Actually, Australia is a great place to trial them because Australian farmers will give it a go, and they're willing to give us a trial row or whatever the case may be to prove out some of these products because they really do need to extract every bit of productivity out of the soils that we've got. So yeah, in that sense, it really does stack up is the simple answer.
Just question also with that international flavour, and it's great that there's some more formulation going in here. So how do you go with, I suppose, your mix of products that you're sort of, obviously you've got international wholesale type groups trying to push stuff through you, and then you've got local suppliers here. So how do you balance that interface?
Yeah, another great question. But I mean, just having a degree of control, we can't replace the supply chain that exists today in China and Southeast Asia and India, and they're going to continue to grow that. So we're not attempting to do that. We're not going to be able to compete with that at a cost level, at an infrastructure level. But owning a piece of the supply chain gives us a degree of control, gives us a degree of skin in the game. It allows us optionality, whether you bring in product pre-made, fully formulated, whatever the case may be, versus bringing in the actives and the incipients and other things. So it gives us optionality. It allows us to keep our friends in those parts of the world honest at times because we know the true cost. And so we think it's a powerful thing to have. We can ramp that up and down a little bit if we need to be responsive to the market needs, to customer needs, and we think that gives us a small advantage as well. But yeah, Paul, I mean, really, the amount of capacity that exists in Australia for herbicides and crop protection products, we will never be able to build the infrastructure here to be able to replace what exists today in China and other parts of the world. So it's about having some skin in the game. Yeah.
Michael Beers, my name. Australia's failed twice to produce SOP in Western Australia. I don't think we produce any MOP. Do you think we ever will produce any? And obviously it depends on geology as well. So you've got to have the right ingredients in the ground. But do you think there's any future ever for Australian production?
You might have to explain some acronyms a little bit because it is a pretty detailed question.
Yeah, so I mean, you're right. The geology in the ground will be a really important thing. Look, you can see some of the fertiliser producers are struggling to be cost competitive in Australia at the moment. And if anything, we're seeing those assets either dismantled or sold. And the likelihood of them coming back, I think, will be challenging. But you never say never. I guess there is a real desire in the marketplace, and that comes from the policy setters and the governments as well to try to have some skin in the game in terms of supply chain infrastructure and to have some versatility in that regard. Again, I do not think we're going to be able to replace all the infrastructure to be self-sufficient on nitrogen and potash and phosphates and all the other things that we would try to produce here. I just don't think that's going to happen. But does it become economical at some point? Maybe with some sort of government intervention or some sort of incentive or remedy, maybe. But to be honest, I'm not aware of any investment going there right now. And I think in the short term, unlikely.
Answer. Got a couple of questions here, Joe, and then Adrian.
We're a farming business. Our biggest carbon source is from fertiliser, depending which state you're in, but it's fertiliser across the board. What's Nutrien doing to sort of bring through different forms of fertiliser that is going to allow us to actually decarbonise? Because at the moment we can't grow anything without urea.
Yeah, 100%. Yeah, great question. Great question. And it's one of the big opportunities, right? It's one of the big opportunities for our market. It's one of the opportunities for Australian growers because they will attack that. And as I said earlier, we're predominantly a nitrogen market at the moment. That's what our soils sort of really need. So precision is sort of the thing that is the real buzzword at the moment. We're doing a lot in that space. We've got a team dedicated to it, partnering with a bunch of players in the market to sort of bring some of that precision application to market. But beyond that, there will be a range of other products that will come to market that we think can make a difference, whether it's nitrogen inhibitors, whether it's fixers or other technologies that we think are going to be really important. Those markets haven't been completely created yet, but again, we see ourselves as on the front line of being able to bring those to market. There's some that are already there, whether it's Nutrien and some of these coating technologies for urea that we think are already having an impact. But we've got to be able to bring cost-effective solutions to market as well. And that becomes a real focus because I think we've all discussed the fact that there's not a hell of a lot of premium in the market at the moment for sustainable outcomes. There's certainly a demand for it, but getting that sweet spot of solutions that are cost-effective and scalable, that's where we're looking. And yeah, again, I'll repeat this for the third time, but plant nutrition is really something that we think can revolutionise the market in some ways, including on broadacre. So yeah, it's a big opportunity that we see, and we hear the challenge in the market loud and clear.
Thanks, Adrian. I've been Luther from CBA. First, congratulations on the MD role. You mentioned increasingly we'll see local manufacturing shut down and replaced with import competition. We're seeing that across a lot of sectors. Do you see the supply chains, port, rail, roads set up to increasingly absorb that shift? And where would you see potential bottlenecks in the future, or where Australia needs to invest in infrastructure to support that?
Yeah, again, really good question. And again, something that we hope can be both a private capital and public investment sort of solution. I think you mentioned the ports, and I won't go down that rabbit hole, although it's tempting, but yeah, I mean, that's one place to start, right? And we had our own little taste of it. Some of you would have seen in the media, we had a fertiliser facility burned down almost 12 months, or a little over 12 months ago over in Quinton in Western Australia, and having to rebuild that at port and work with the authorities there. Difficult. Ultimately, we've got an outcome that we think will be good for the market. But yeah, if that's any indication as to how what the process is like to get critical infrastructure that we think enables our market to function properly, then yeah, we've got some work to do. But like I said, it's got to be attractive for private capital. I think government's got a role to play as well in terms of investing in critical infrastructure that makes sense, and whether they lure public capital or make direct investments themselves. I think that's important. So yeah, the port's really a big focus for us. And then manufacturing capability, I think the economics will tell that. I don't really see government intervening to try to get onshore manufacturing back or anything like that. So I think the economics of that will play a role. The best thing we can do is just have diverse and nimble supply chains that are not overly dependent on one single market or one single geography. And that's easier said than done, and we're nowhere near that right now. But that, again, is what we're planning for. And I'm sure many in this room are asking themselves the same questions around their boardroom tables. No easy answer, but there are incremental things we can do.
Great. I think we'll save later questions for the panel, but that's fantastic. Thank you. We're very pleased to have Mark Barber here from Elders. He's going to wear a few hats, which is great. And I think most people know the Elders story very well. But what Mark and his wider interests in associations have done is bring together the Agribusiness Association, Agribusiness Australia rather, and Agribusiness Australia. I've got to get it around the right way, don't I? I'm on the board, so I should know that's what's going on. But what we have is a number of challenges that have been thrown not just at Elders, but at the wider sector. And we're very pleased to have Mark here because, and this is part of the reason why we brought forward the conference, was to be associated with some things that Agribusiness Australia are doing. We've got the Global Food Forum tomorrow, trying to get this critical mass together in this industry. One day, as Emma was talking about earlier, we hope to get a vote or one version of a vote with us as well, but that might take a little bit of time. But Mark has led some discussions in the last few days with Agribusiness Australia on some themes that are really going to affect the cycles that we're going through. And he's very pleased to talk about that informally today. And take some questions from myself and the audience. And on elders, nothing about numbers at the moment. It's a bit tricky with half year end coming up. So we'll just stick to the industry wide and some general questions about elders. Thank you.
Look, as Paul said, we're elders in a blackout. Now, hopefully the results are due out on the 22nd of May. So I really can't say anything about the company, or nothing I say should be taken in any sort of inference as to where Elders is going and the performance and like results and things like that. But very happy to talk about the industry or the sector as a whole, wearing my president of the Agribusiness Association hat. We've just come out of a CEO summit where we collect a number of CEOs from across our membership base to talk about issues that are on their agenda. And again, that was a closed door session, but I can give you some sort of indications of some key themes that are coming out of that and what's on their agenda. The Agribusiness Australia, for those who don't know anything about it, it's coming up to about 40 years old. It's a representative organisation of the agriculture sector, so sort of from farm gate and input suppliers, all the way through to the wholesale. It's a very broad church, and its ambition is to help the sector grow to a $300 billion sort of gross value of output by 2030. Our philosophy is if the farm sector the farm sector has an ambition to get to $100 billion, then the services that add value to the outputs that farmers produce and the inputs that we put into the farm sector mean that if farmers are going to need to get to 300, we as a sector need to get to somewhere around $300 billion because we add a lot of value. So we've got to grow and contribute to that growth. So we run a number of events around the country. We have panel sessions, we have invited speakers and things like that. And I think if I just reflect on some of the themes that have come through our events over the year, that gives you a bit of a sense of, perhaps what's on the radar in the sector. And I can talk a little bit about some of the high-level sort of themes that came out of the summit that we've held over the last couple of days. So over the last 12 months, we've worked on ESG, environment, sustainability, and governance. Environment, social, and governance themes within the sector. How companies are sort of how companies can actually generate some value out of that, some shareholder returns. That's in a couple of different parts. It's about mitigating and managing the compliance costs and the mandatory reporting that's just increasing. And then it's about, how do we create a competitive advantage as a sector and meeting people. So as a sector, a lot of it comes back to telling us a better story about what we do. There's a very strong correlation between sort of preservation and improvement of natural capital and productivity. So a lot of the discussion has been around, well, how do we actually tell the world that we do it in a pretty good way, that whole clean and green image, but being authentic and substantiating that. So it's about measurement, it's about tidying up areas that are a little bit untidy, I suppose, and where we can make some better progress. So we have had a working group going. So there's a number of companies that participate in that working group, and they share ideas because it's very much what we're experiencing is very much a pretty competitive issue that the industry can work together on. So I suppose from this type of forum, I think you should take some comfort from the fact that the industry is coming together and working on this sort of this topic with a very clear, pragmatic, authentic sort of approach to the results that they want to generate from it. There are a couple of other topics that have sort of popped up during the year that we've had a lot of interest in is the reaction of the particularly the irrigation sector, to the restoring our rivers reform. We had 2 events where we got over sort of a couple of hundred people to each event, and talking about, okay, well, you know, there's a need to balance the preservation of the resource, but also there's going to be some productivity impacts that will come out of that, and some production impacts that we need to manage as well. So we've got some clarity around that now, and it's about working with government to understand how it's going to target its buybacks, the water savings measures that are going to come out of some of the investments the government's making, and then you know, what do we do about infrastructure, and making sure that we don't have sort of water taken out of areas that leaves infrastructure stranded. So that was sort of a key theme that came out of that. Labour productivity, it's a bit of a sleeping issue for the sector. You know, the statistics I think are quite frightening around labour productivity. Generally, we've seen a pretty steady decline in labour productivity growth over the last 10 years. And as you know, and I'm dealing with a lot of members that are very exposed to labour costs, and it's labour availability and labour cost, and with the pressure on wages at the moment and the industrial relations systems we've currently got, you know, productivity, improving productivity is actually critically important, and it's not on the agenda of government, and our industry wants to put it back on the agenda of industry. You know, we've got labour productivity rates that are sort of sub 1% now per annum. If you look at the ABS statistics, where we used to have double that sort of 10 years ago. Certainly COVID's impacted on that, but it's certainly a really important issue. Access to labour too, and the visa regimes that the government's working on to make sure we've got labour coming into the sector is really important. And there are a couple of other areas that are really important for the sector, and they're working on is we're working on the organisation is you know, clearly government red tape and overreach. You know, there's a huge cost, and I think it's really good. That's what I'm telling you. Market access. We had a very good presentation from Andy Henderson, one of the authors of the food security green paper that is going to be released in the next couple of weeks. In the sort of the vulnerabilities that's exposing in our supply chains is quite staggering, and the preparedness that we have to deal with some of those vulnerabilities, quite frankly, you know, is pretty low. You know, food security is a topic that you know, people perhaps consider quite naively. We export more than 60% of what we produce across most of our industries, a lot more in some of them. They're going to run out of food. Well, it's the inputs that are required to produce that food, to prepare it in a way that's consumable and able to be delivered to the population in an efficient manner. The vulnerability you have in supply chains, you know, coming out of the strategic group, the national strategic reviews around the Indo-Pacific region, are sort of highlighting that we are very exposed and we need to build some resilience. But you know, that comes at a cost. Our supply chains are efficient now because we have relatively open and free markets. If we have disruptions and want to build some redundancy, then how do we compare it to the risk that we face, and who's going to pay and how's that going to be shared? So that was came on the back of the government's announcement of a $3.5 million investment into the next stage of that work, which sort of hasn't been very well defined yet. But I think when the back will come out, it'll certainly sort of step through that. The challenge for us is to get it down to what can individual companies do to assess those risks and understand how they can mitigate them in a cost-effective way. Energy is also on the agenda. We heard a presentation last night from the Independent Food Distributors Network, the cost pressures and the margin compression that they are experiencing from the cost of energy. And when you think about it, they are a very energy exposed sector because they run a lot of cold chain. So their whole business is about cold chains and transport, really, at the end of the day. The electricity price is going through the roof, and they're vulnerable to diesel fuel costs and availability as well. So that was an interesting discussion, and I think that sort of wrapped up where sort of the direction of the discussion went this morning and over the last sort of 12 months.
It's a good overview, and I think you painted I suppose the broad picture of the challenges, but I think talking about how companies and farmers respond to those, because we're here because the response typically has been very resilient, and I think, as someone pointed out before, the balance sheets of farmers are in a reasonable shape. So with a bit of direction, there is some growth ahead. I'm hoping that's the case from your.
Oh yeah. I mean, it's not all good to do. I mean, the fact that what we're seeing in the farm sector, I suppose, is that we are seeing continued consolidation in the farm sector. And that's an ongoing trend, but in the face of margin compression, cost pressures, and things like that, I can only see consolidation sort of keeping going. I mean, at Elders, I'm the GM of rural real estate, and we are seeing interesting shifts in land sales patterns across the country. Liquidity has dropped off quite a bit in terms of the number of properties that are being sold. But we're seeing an uptick in the number of properties over $20 million. So that's been driven by liquidity at that end of the market. So we're seeing a lot of bigger players and institutional investors entering the Australian market, which creates liquidity, which creates a bit of turnover. We're also seeing the underlying issue there is consolidation. And I think we're only going to keep seeing that. If you look back at some ABARES sort of work that was done over the last few years, our rate of productivity growth has been the farm sector, competitive with our international trading partners, which it has to be if we're going to maintain our position in export markets. But a lot of that comes from consolidation, which is scale economies. The other thing we're seeing is the automation of the farm sector. So the farmers are making conscious decisions to switch out of labour into capital. So they're substituting labour for capital. There are some sectors that can't do that very well, and but if you look at perhaps the cropping industry, for instance, we're seeing massive scale come into the equipment that's being used, industrialisation perhaps of farming properties in terms of the way they go about configuring their farm, managing their farms, and that's impact down the supply chain as larger amounts of grain are sort of need to be followed. But and we're seeing, I think, as you're talking about construction and food industry, a lot of that's to do with labour and labour productivity and the lack of it.
Kind of quick one for me is with the Thomas Elder Sustainable Group. That's tapping into that capital productivity improvement. And that's what Elders has done well. And I think PAC's talked about, and obviously Nutrien's got an international sort of flavour in that innovation space. So is that something you see growing significantly within Elders? I don't know the question you can add away.
No, that's right. I'll talk in general terms. I think that going back to the discussion we had at the Agribusiness Forum, I think what we're starting to see bubbling up is yes, there's a pretty big compliance burden that needs to be managed, and I think our sustainability team, can help with that. So that's measurement, baselining, improving productivity, taking advantage of the intersection of sustainability and productivity, and making sure that a holistic decision is being made by the farmer. It's about productivity and sustainability, not in isolation. So I think as a company we're responding to that, and And also, I think what we're starting to see is, where's perhaps some competitive advantages are starting to be sort of identified by the sector and starting to be explored. Principally around environment, I think it's sustainability, where we can tell a better story by measuring and telling what we do better. And again, looking for that intersection of productivity and sustainability.
Fantastic. Thanks for jumping into the breach almost, and with the Business Association, and I think it does give a heartfelt implication of the challenges and the next steps, and looking forward to sort of getting those sort of different points of view in the panel as well. Mark, so thank you. Well, the smartest people in the room, and someone that's been on the journey in the ag space, personally, your whole life, I think. In all sorts of places. He's Quinton, Hildebrand, MD of Ridley, and it's been through a fantastic re-rate to a platform, and really Quinton set up and justified the next 3 years of the next level of growth. And Quinton's here to talk about quickly the past 3 and the next 3. Thank you.
Yeah.
Thanks. Well, while they just setting up the presentation, I might just give you a quick overview on Ridley for those who aren't familiar with Ridley. So we're an ASX listed company, ASX 300. We have been listed since 1987 and have a turnover of about 1.2 billion and 700 skilled and highly engaged employees. It's really a portfolio of different businesses that come together, and I think as we will go through the presentation today, you'll see that it really does meet the theme of the conference today, the sustainable returns through the cycles, and I think hopefully you'll see that this portfolio of businesses does give us a fair bit of resilience. We've got 2 reporting segments. The bulk stock feed segment, which comprises 14 feed mills down the east coast of Australia, and we account for roughly 25% of the feed market sector. And then we've got a packaged and ingredients reporting segment. The ingredients side is comprises rendering businesses here in Melbourne and in Sydney, which would make us the largest renderer in the country. And then recently we bought a pet food ingredients business in New Zealand, and we have an operation in the South Island as well as one here in Laverton in Victoria. The other part of the packaged and ingredients is the packaged products business unit, and a lot of our products going through my panelist friends, Nutrien and Elders and others, supplying stock feed into the rural sector, as well as mostly pet food ingredients into the domestic grocery chains. And lastly, we have an innovative startup called Novac Pro. Novac Pro was a CSIRO discovery, which we're in the process of commercializing. So today, I am taking the opportunity to reflect on the 3-year strategic plan that we launched at this conference in May 2023, and May 2022. And this is a sort of a recap of it and a bit of a demonstration of the work that we're going into to set ourselves up for the next plan. So that's a summary of what our plan has been. It's a pretty bold plan focused on optimization and growth. and underpinned by our sustainability pathway. We have focused on key initiatives, 7 in bulk stock feeds and 9 in the packaged and ingredient segments. And as you can see on the right-hand side, the traffic lights there, the majority of these initiatives have been delivered over this period. And the resultant financial performance, you can see our EBITDA started at 80 million on the left-hand axis, and first year 88.5, last year 92.8, and at our half year we were 50 million. So hopefully we'll be above the 100 in our third year. So now I'll just go through the strategy itself and the delivery against those in the different segments. So if we look at the bulk stock feeds strategy, it's really leverages what we call the flywheel impact as we bring together our procurement scale. We're probably the largest domestic consumer of raw materials for our customers, and we're leveraging that with our nutritional capability and algorithms and technology. Allows us to bring a value to our customers that has enabled us to continue winning new customers, and hence the share of the industry that we've been gaining. And through this 3-year plan period, our growth in the ruminant sector has been a CAGR of 11% through the period, and that's required us to expand our capacity with 2 debottlenecking projects at 2 of our ruminant mills, as well as we required the carrick feed mill down in Tasmania. In the monogastric sector, where our biggest sector is the broiler chicken industry, they had a genetic issue that impacted on their breeder numbers over this period. But nevertheless, and augmented by growth in our supply to the pig and layer sectors, we've achieved a 2% growth, and we've debottlenecked 4 of our facilities during this period, and today are operating mostly on 24/5 operations with the capacity to expand in the coming years. And then a new initiative that we brought in this plan period was the launch of a business unit called Ridley Direct, and pleased to say that from startup to where we are today, it accounts for 10% of our volumes and is accessing customers, farmers, who we previously didn't have relationships with. So that's been a successful initiative for us. Lastly, just in terms of some innovative work done by our teams, the commercialisation of Barber blends in the dairy sector in the Western Districts, and then also in this period, just expanding our footprint and now having a facility in Tasmania. So if we move to the packaged and ingredient segment, and here the ingredient recovery business has been focused on climbing the wall of value, and we've seen over this period the percentage of premium products that we produce has lifted from 21% to 30%, and that's mostly come about with the acquisition of this pet food ingredient business, where we are taking raw materials that we were receiving previously and supplying them direct into pet food customers, a lot of them novel proteins, ovine or deer, kangaroo, into overseas markets, and that has given us an integration into the pet food sector, which is assisting our margin climb. On the rendering side, our facility in Sydney has doubled its volumes with the closure of a competitor in the Sydney Basin, and that gives us an opportunity to reinvest and look at how we can premiumise our offering in that facility, as well as there are other debottlenecking opportunities within the Melbourne facility. So a fair bit for us to get on with going forward. We go to the packaged products. This business unit required us to pivot quite significantly during this planned period. And with the better returns from pet food, packaged pet food supply over what this extrusion plant was previously producing in AgFood, meant that we've swung hard to pet food. We secured early on some packaged grocery house brand contracts, as well as some pet specialty contracts. And, with the confidence of that, we invested in a packing line up in Brisbane. And so today we have an integrated offering. We are the producer of the raw materials through our rendering ingredient recovery business. We've got a large-scale extrusion facility. We've got a versatile packing function, and we're well positioned from there to meet the market. And so we're in the process of shifting our production from 24/5 to 24/7 in the coming weeks to meet the opportunities that we have ahead of us. And lastly, as I mentioned, the Novak Pro startup, with us withdrawing from the domestic aquafeed supply, we've honed our expertise and our team to concentrate on the commercialization of Novak Pro in the international market. And pleasingly, we've had our first registration into the Thai market, and we should get access into India, Indonesia, and Ecuador imminently for the latest iteration of the Novak supplement product. I think importantly, within the construct of Ridley is managing our capital. And back in 2021, with the leadership of our board, we put together this capital allocation framework. And through this planned period of the last 2.5, nearly 3 years, we've seen our cash flows driven strongly, obviously increasing EBITDA, but good cash conversion. We've continued to invest in the sustaining the requirements of our facilities, maintaining a strong balance sheet, which has given us enormous optionality. We stay below 1x at the moment, even though our stated target is between 1 and 2 times EBITDA leverage. But that's allowed us to pay progressive dividends over this period, continue to fund significant organic growth, talked about the debottlenecking projects and the like, and also undertake 2 acquisitions last year. And through this period, we've delivered a 22% total shareholder return CAGR, which is above our target of 15%. If we go to the sustainability focus, and we've always had sustainability as a line function. Everybody in their respective business units needs to deliver the performance on a sustainable basis, but it needs to make sense for the business. So we've got 14 initiatives across the business, and they don't waver whether it's woke or not. They are things that deliver value for the underlying business. And so you can see that our 2030 targets that we've got there, that's just a snapshot. As at financial year 25, we've met all of our sustainability targets and gone ahead on a few of those. So lastly, just looking at the preparation for the next strategic plan, which we'll bring to the market before the end of June this year. And I've spoken about the past 3 years. I'll ignore that. But if you go to the right-hand side, the board has spent the last 12 months really working up what are the key focus areas for our business. And we think that we're able to extend our core competencies to grow the business in the coming 3-year plan. And it's been recognised early on that you need the leadership capability and breadth to be able to take on more. And so for some time now, we've been working with the existing leadership team and bringing in new parties who are bolstering our capability. So I think, strategic plans don't happen the day you launch them. They've got to start a few years ahead. And fortunately, with the leadership of our board, we've been on this journey for some time. After that, it's about determining what are the key priority areas that you're going to focus on. And so, there's a little bit of the same, but there's also, focus on new. So the 5 areas that we've determined to prioritize are continuing our journey in the bulk feeds. How do we grow our market share even further and leverage our position there? Integrating further, particularly into pet food with our ingredients, given the opportunities that are presented by that market. Expanding our packaged products business, and whilst that's retaining our rural distribution, it's also house brands and the focus that we can deliver for corporate customers there. And then commercializing the Novak Pro opportunity in this planned period. And lastly, leveraging our existing strengths to see what other services we can deliver within the ag sector. So, is there an opportunity for us to have a 4th vertical within the Ridley stable that's complementary to our skills and has synergistic benefits across. And obviously, all of this needs to be done with a key focus on capital management and the financial returns. So, in advance of that, and having cleared up what are our key core priorities, it created us to think more clinically on what are we going to do less on. If we're going to do more on some areas, what are we going to deprioritize? So we've, halfway through what is a streamlining through the entire business. There's some areas that we've deprioritized and are withdrawing, and there are other areas where we're adding roles and adding focus. And so at the end of this process of resetting, we would have reduced our cost base quite significantly, a $5 million EBITDA per annum reduction, and there's an upfront cost of about $3.5 million for that. But all of these things are part of us ensuring we have the focus and the discipline and the capability to be able to execute on the growth plan going forward. So Paul, that's a wrap of the presentation, and happy to take any questions. Thanks.
Excellent. And if you wind back sort of 4 years when this all started, as you say, at this conference, when you first came in at Ridley, you outlined the growth plan, and not many people believed you back then. Share prices up from what, 60 cents to $2.40. So there we go. That's what happens, and it can happen. So it's great to have Quinton here, and I think people need to stand up and take notice of the next 3 years, because this is a very strong platform in the making. Now, but the question for me is, and maybe it's around that. I mean, when you came in and did that 3-year plan, I mean, how confident? I mean, it's good in hindsight, but how confident were you that you could deliver? And I suppose then that leads to how confident are you that Ridley can take the next sort of 2 or 3 times step up from here?
Well, I'd say it takes a team to deliver this, and it takes a supportive and skillful board to help shepherd the outcomes. So if we look back, and so this plan was the second 3-year plan that we had put in place. We had success in the first plan, so there's a level of momentum. There's a level of belief that, well, we've come from a certain place, we can go there again. But I think with it all does come the tough decisions that have to be made along the way. And I think what we've created within Ridley is this desire for us to deliver for our customers, deliver for the shareholders. And there'll be times when you're picked on the team, and there'll be times when there's a different game plan. And so I think that's a philosophy that we've tried to bring through. And another key component is, and this was set up by the board 6 years ago when I was joining, but to have people behave like owners in the business. And so we have a lot of participation in the shareholding within Ridley. We have an employee share scheme, and that means that when I have a town hall with the team, with the broader staff, an operator in one of our operations, he will put me under the pump and say, I'm a shareholder. Why are we doing that? So it's pretty good because they want to see the returns. They've also enjoyed the participation in the journey, and I think there's a realism that means we have to be pretty focused and disciplined as we go.
There's one in the middle there, James.
Thanks, Quinton. This is Andrew Delios. I have a question on your ability to extend into different services in the ag sector.
Yeah.
Could you give an example of how big that opportunity is and what different complementary verticals might be?
Yeah, so we're a listed company, so I'll be very circumspect, but I can tell you the competencies that we have within Ridley are around commodity price risk management, around supply chains, around light manufacturing and processing, and customer network through particularly the Australian market and then through corporates. And so those are the core competencies that we have, and anything that we do needs to be within that skill set. And then thereafter, the size of, we won't get into the US, so I'll be categorical on that. But the size of the investment and those kind of things, it really depends on the financial returns and metrics for that.
Very well done. Couldn't have done better. And the question was better than mine, so there we go. Excellent. Thank you.
Hi, Quinton. I'm Lily Plumridge. My question is your sustainability targets. I thought they were awesome, but you also said they don't waver regardless of wokeness, which is so fair. But as technology and understanding of sustainability adapts, are the targets subject to flex so Ridley can achieve to the best of its ability?
Definitely flexing those. What I'm saying is, well, it depends what the drivers for the flex are. Usually business driven and not political views. So we've already focusing on the CO2 reductions. Clearly the easiest ways to focus on that are getting gas and electricity efficiency and reducing consumption. So we've actually, you'll see those were areas where we've gone ahead and we're actually having to reset our target because we're going to get to our 10% reduction in CO2 well before 2030. So yes, we will reset, and so it goes. One of those sustainability targets was in aquafeed and reducing the fish in, fish out ratio, and we've achieved that, and we've actually led that. But we're now exiting that sector, so it'll change. So yeah, we will continue to evolve them and make sure that they're relevant. But where I was meaning is, the world's going through a bit of a pendulum swing on the focus on sustainability. I think we weren't at the bleeding edge, but we also have no reason to doubt ourselves in what we do.
A great question. Thank you much, Glenn. Look forward to the panel shortly. So our last speaker for the session before we jump to the panel is Rob Spurway, MD of Graincorp. Again, another person's been through a number of cycles in the dairy industry first, and now in grain. And this is a perfect sort of thematic for Rob to talk about, because he has smoothed out the Graincorp earnings through the cycle, and again, he's got another 3-year plan to do the next step. Thank you very much, Rob.
Thank you, Paul, and good afternoon, everyone. Look, it's a pleasure to be here, and thanks again to PAC Partners and Commonwealth Bank for their sponsorship of this. Nice to be here at KPMG's offices as well, and my pleasure to present to you and share the Graincorp story. I'm going to take just a few minutes to talk about Graincorp as a business with over 100 years of history. We're still, in many respects, misunderstood in terms of the capabilities we have, the quality of our assets, and the way we earn money. I'll talk a little bit about the strategy and growth, what we've done, as Paul said, and importantly, what we're going to do. How sustainability is at the centre of that. It's a critically important area for the farming sector, and of course critically important to Graincorp as well. I'll provide you a financial summary and then also talk about outlook and some conclusion remarks, where you'll see very clearly, I think, that theme of sustainable earnings through the cycle coming through, and certainly through the cycle and earnings, and our guidance of through the cycle earnings is something that I think Graincorp has become known for. So starting with our network of assets, Graincorp is a very large network of assets. That's really what we're all about, is our people and our assets. In Australia, that looks like 7 ports connected to over 160 storage sites for the receivable, storage, handling and export of grain to both domestic and global export customers. We also have a number of processing sites, principally crushing oilseed, but also food site that turn that oil that we produce into a range of consumer and food service products, serving customers here in Australia, New Zealand and across Asia. We also process a range of supplementary feeds for our feeds business, and I'll talk about how that works and how we connect our assets together very shortly. But importantly, we're connected around the globe through our global offices, network of offices, principally focused on connecting our grower customers with our end customers around the world, but also giving us access to what's going on in the marketplace and the grains that we handle, not just from Australia, but originate out of places like Canada. We have an office in Kyiv in Ukraine, so it keeps us well connected to global trends around the world, and that places us well for the future ahead. How we operate. Our assets come together to create a really valuable integrated end-to-end value chain. And I use that deliberately. It's obviously a supply chain, but we talk about it as a value chain. And one of the great improvements in Graincorp over the last 4 or 5 years has been the integrated nature we think about our value chain, and the way that we make decisions to drive value that are in the best interest of that overall value chain. At its heart, we connect more than 10,000 growers on the east coast of Australia through our assets to hundreds of customers not just here in Australia, but also around the world. We also connect with growers in Western Australia and in Canada to supplement our East Coast business to the world with our international business. And I'll talk about the contribution from that as well. We crush over 540,000 tonnes of oilseed. That produces products like canola meal, which is complementary to our animal supplements and feeds business. We have over 100 years of experience in the tallow business, collection, consolidation and export of tallow, alongside 50 years or just over 50 years, we celebrated a couple of years ago now, in our used cooking oil business, Auscol. So that rounds out our exposure to our assets exposure to food, feed and fuel, which is a really positive place to be in terms of the benefits we've achieved in recent years and the opportunities we see ahead. If we convert that through to our strategy, our vision, quite simply, is to lead sustainable and innovative agriculture through another century of growth. We've called out 3 pillars here: enhance, expand and evolve. All areas where we've built significant credibility over the last 5 years in particular. Improved asset utilisation, cost and capital discipline, and margin improvement, ultimately delivering improved return on invested capital. We see opportunities to expand in processing, in particular across food and feed and agri-energy. And I'll talk about some of those specific examples in the next couple of slides. And then evolving, if you like, the enablers that we use. We've been very successful in adopting technology. We've got a very capable advanced analytics unit that has been really foundational in building the capability to improve the throughput through our processing assets, reduce cost, and very, very powerful in that planning and logistics across such a complex network of, as I said before, 160 sites across Australia, 7 ports, and multiple hundreds of customers around the world. And that, as I said, sets us up very well for future capabilities. Something I think that we should all reflect on is just how privileged we are in Australia and the macroeconomic opportunities that we're exposed to. And they are front and centre in terms of the opportunities for Graincorp. We see population growth, particularly across Southeast Asia, and our geographic proximity to those markets give tremendous opportunity for growth over the long term. We've got leading positions here in Australia in our East Coast handling and proximity to those markets to growers with markets across Asia. Decarbonisation is, of course, fundamental to farming and the importance of the weather in that. We've demonstrated tremendous ability to respond to the conditions that are available, but we also have the scale to respond to that and diversify where we need to. And we have strategic initiatives supporting decarbonisation, whether that be our investment in future feed, whether it be some of the initiatives we're doing with growers, or our investments in other technologies that not only are likely to decarbonise the sector, but also achieve improved productivity and growth for growers, which helps our business directly. We've certainly seen through the pandemic disrupted global supply chains. Very aware of the talk of where the world's going and the propensity for potentially more disruption. And Graincorp's very well equipped around that. We manage our supply chain, including the charter of vessels to our end customer. And so that gave us tremendous resilience in the last disruption and sees us well placed for the future, whatever that may hold, and also to capitalise on those opportunities as they come along. And I've talked about already digital and technology acceleration. We're adopting that into our business and everything we do, and we see that as an important way to drive future growth as well. I do just want to dive into a few of the examples of what we've demonstrated, but as we talk about what we've achieved, we're also clearly signalling our intended future growth. And diversification of non-grain port earnings is one of those specific initiatives. Our ports are, in many respects, a jewel in the crown of our assets, 7 bulk ports that are primarily focused on exporting in the order of 9 to 11 million tonnes of grain to the world from East Coast Australia. The bottleneck in that supply chain, though, is the road and particularly rail network. Getting that grain from upcountry down to the ports takes us about 6 or 7 days to fill a port for a Panamax vessel export, which we can load in 1 or 2 days. So in those 3, 4, 5 days on average a week that we have latent capacity, we handle a range of other products like wood chips, fertiliser, cement, sand, meal and other products. And that's really improving asset utilisation. And for the first time late last year at our financial results announcement, we shared the additional disclosure of the growth that we've seen in contribution margin in that part of our business and the $36 million that we're contributing in financial year 24. And I think that clearly signals the growth trajectory we've been on, initially focusing on volume, but more recently over the last couple of years, really focusing on the margin from that important part of our business. We've also talked about decarbonisation and sustainability, and I think our focus on the opportunity for oilseed crush expansion as a feedstock to what we believe inevitably will be domestically produced sustainable aviation fuel and renewable diesel is a great opportunity of sustainability and commercial opportunity intersecting, and it's an area that Graincorp's excited to be working on. Our focus has been on developing the partnerships, the memorandum of understanding we have with IFM investors and Ampol, specifically looking at the opportunity to produce sustainable aviation fuel and renewable diesel at Ampol's Lytton refinery. But as part of that, looking at what are the government policies and settings that are required to create certainty for investment, to create certainty for demand, which we would need to invest in a significant step change in our oilseed crush capacity. And that project's has commenced and is progressing well, with even some recent positive comments from the government and commitments from the government around the Made in Australia commitment of 250 million and their ongoing focus on what are the right policy settings and the role that government might play in things like mandates, such as we're seeing in Japan, Singapore and other markets around the world. So it's a work in progress and one that we expect to continue to see developments over the next year or two. I would just say that one of the questions we often get asked is, how does the food versus fuel argument play out? The reality is about 60 or 65% of the oilseed we currently export from Australia, principally to Europe, gets converted into fuel. So this is a real opportunity for onshoring sovereign capability in Australia, investment and jobs, and greater demand signals for growers, which of course helps productivity and helps opportunities for Graincorp. The next one I want to talk about is Graincorp Next, which I hope many of you have seen on our social media channels, in the media, and indeed on our website. It's a program that really connects growers with end customers around the world by highlighting the best practice that's available and demonstrating it throughout the value chain. It initially focuses on canola and low emission canola particularly, but we expect to expand it over time to include other commodities and include aspects such as nature positive initiatives as well. The focus has been around signing up growers that are interested in understanding and mapping the data on their farms and employing new technologies. We're delighted to have been partnered with Nutrien, who are in the room on that work, supporting farmers, but then also the investment we're making and demonstrating through our processing and nutrition and energy division, where we're using, in some cases, renewable energy, solar panels, renewable diesel, to be able to provide not just a theory or a model solution, but a real solution to end customers that we're signing up around the globe. So if they want to see a low carbon canola product, we can provide that to them, and we can establish ultimately what the economic opportunity is for Graincorp and the farmer by determining what those customers are prepared to pay. So it's a really exciting example of taking the theory, putting it in action, and I was delighted just a week and a half ago to spend some time with 40 odd farmers that came together in Yarrawonga, where we talked about the opportunities I've seen in the first few months and the plan ahead. So great to see that support from both farmers and global customers. Now, if I move on to the financial performance of the business, we talk about our earnings through the cycle, and we've guided the market to 320 million EBITDA through the cycle. If you look at the last 5 years, and the reason we take 5 years and 6 including this year, is we demerged our malt business. So Graincorp, really on a like-for-like basis, can be looked at over the last 5-6 years now, if you include 25. And it includes, what we'd describe as, broadly an average year last year, with very dry conditions in the north and offset by good conditions in Victoria. But it also includes the second year of deep drought back in financial year 2020. And it demonstrates over that time, Graincorp has been able to grow its earnings, and most importantly, the leverage we have to the upside, 22 and 23, delivering earnings of 703 and 565 million respectively, really shows how we can leverage the upside and produce that result for shareholders and stakeholders when the conditions are right, but also shows how we're protected against the downside. And on the right-hand side, you can look at our average earnings as we look back, bearing in mind that the 320 is our look forward based on what we expect in any given, say, 6 to 10 year period. But if you look back, our earnings have been significantly higher than that, 377 million over the last 5 years. But if you take out our crop insurance product, which protects the downside, that becomes 421 million. The reason we take that out is we've now reached a cap on that product. And for those that follow us closely, you'll know how that product works. For those that want to know more about it, it is in all of our disclosures. And that means there is upside potential ahead over the remaining 4-year life of that contract. So it really shows the profitability of the business, but the strength of the business in terms of taking out volatility year to year and focusing on the longer term, medium term and longer term profitability and earnings potential of the business. What I'd say is it really shows that even at 320, it's very undemanding if you look at the opportunity for good years when they occur and Graincorp's ability to deliver on those good years as we've done. We also disclosed at the end of last financial year the building blocks of our 320 million through the cycle and how our business is structured. We have, of course, 2 reporting divisions, the Agri business and our Nutrition and Energy division. And within those, we've shown here, broadly speaking, the proportions of income. Our Agri business is made up principally of our East Coast to the world business, but also our international business, which includes cross-border trade and grains from places like WA. We, in our Nutrition and Energy business, have animal nutrition and our foods business. And we would expect diversification of all of those areas over time as we continue to invest in our strategy and grow and diversify our earnings and improve the quality of our earnings over time. How are we going to do that? We're very well equipped with an exceptionally strong balance sheet. We've been providing strong returns to shareholders and investing in the business. At September 30 last year, we had core cash of $337 million. On the right-hand side, you can see the dividends that we've paid to shareholders over time. 28 cents annually as a dividend, so the 2 half-year dividends of 14 cents each period, broadly support the 320 million through the cycle if you do the calculation back based on our capital management framework. We've been continuing to provide special dividends, reflecting the strength of earnings in the business, our confidence in the outlook and the strength of the balance sheet. And it leaves us in a position where we still have plenty of opportunity for ongoing capital management and return to shareholders, as well as investing in the strategy. So Graincorp's in an incredibly strong position as we move forward. I'm really just capping that off, and in conclusion, our business and our strategy is underpinned by very positive long-term macroeconomic fundamentals, growth in population, proximity of that population to Australia and the demand for grains generally, as well as increasing supply in Australia. We've demonstrated incredibly strong operational execution across our integrated network, and that's evidenced in the earnings we've achieved over recent years and in our outlook period. That allows us to present with confidence our through the cycle guidance of 320 million in EBITDA. And that's on a like-for-like basis. We'll increase that obviously as we complete initiatives and as we deploy capital for growth. We've got a balance sheet in that respect with very significant flexibility and importantly, I think a track record of delivering shareholder returns over time. So Paul, very happy to take any questions, and I'm conscious it's now the panel and me between lunch and what comes next.
Right. Well, I think there will be some questions because again, it's a case that you've set out to have a plan. And taking on the Western Australians is perhaps an area that we can explore a little bit because there's obviously another group that wants to put together a plant there. So is there an opportunity to all work together, or do you think it's just going to be two groups fighting it out, basically?
Look, I assume you're talking about the craft plant in particular, yeah. Yeah, look, you'd always say there's opportunity for partnerships, and it's probably best to talk about those that we've announced, including the MOU with Ampol and IFM, particularly in the ambition that Australia has for sovereign capability and renewable fuel and the benefits that will bring to the economy. There are a lot of parts of that value chain that need to come together, including the government policy. So we're delighted to be working with others. We would expect to work with others as that comes together and gets closer to reality. We're also pleased to have a seat on the Jet Zero Council, which gives agriculture a voice in how this is developed, because obviously the fuel majors have a role to play at one end of the value chain. They ultimately need us as much as we need them from a feedstock point of view. So, I certainly wouldn't buy into, taking on the West or this East versus West thing. I would remind everyone that Graincorp already has a oilseed crush facility in Western Australia. We've moved grain out of Western Australia to the world for many, many years. We're a significant customer as a result of that of the CBH network in Western Australia. So, our business is one that is focused on sensible diversification within Australia and diversification of markets around the world, which is just good business.
Yeah, good business. We have sport, but this is real, and I think that's I suppose the thing that we're going to bring out in the panel, that Australia working together is better than the sum of the parts. All right, and the final one for me, and again it's going to be drawn out in the panel a little bit, but is you can talk about your Grain Innovate or your venture capital group. And you're one of the few that's really got a venture capital group within the company, and it's a pretty bold move. Is that something that Graincorp's totally committed to going forward, or is it something that you're just doing for a while to see how it works?
No, look, our fundamental objective in having investments in technology and future-focused businesses is to get a significant return on that capital over time. I think the portfolio of investments that we have is a way to de-risk that, spreading the risk and ultimately the opportunity. It is focused on businesses that are likely to bring broader benefits to the ag sector and growers. And what we mean by that is if we can invest in a technology that improves productivity and grain production on farm, as one example, that directly benefits Graincorp ultimately. But also benefits our growers as key stakeholders. We also look for investments that support our sustainability objectives. We think that's for the future. And most important, we look for investments where our involvement can achieve more than just purely the financial investment. So the scale that we have, the opportunity to scale some of those technologies by improving connectivity, and deploying that across the grower network that we work with. They're the sorts of things we look at. Finally, it was a very pragmatic approach to it. Back as our earnings were growing significantly and we were focused on that area and a strong balance sheet, the market was understandably asking, well, how much are you going to commit to this? The benefit of a venture capital type approach to it is we're able to ring fence it and make sure that we stay focused on our core business with very few people connected into how we invest there, but drawing on the expertise of Graincorp, as I said, to leverage our capabilities and scale these businesses. and also to cap it at, broadly speaking, 10 million a year. So 2 to maybe 3 investments a year, total cap of around 10 million a year, keeps a very modest exposure on what we hope will not only deliver benefits for Graincorp and the industry, but significant financial returns over time.
Rob?
Rob Nelson, I think it was about 4 or 5 years ago when you took on the in terms of risk conversion, the insurance policy, the cap and collar. What would have been your learnings out of that, and has it been adopted by other grain companies in Australia?
Short answer is I'm not aware of it having been adopted by others. I think in that respect it remains a fairly innovative product. It was taken on nearly 6 years ago now as part of the demerger of the malt business. It was at a time, obviously where Australia was in 2 or nearly 3 years of drought. And it was there as a way of protecting the balance sheet and avoiding an otherwise more conservative balance sheet at the time. So I just will spend a minute to explain how it works. It's a derivative product. We pay an annual premium of $6 million. It's got a 10-year life, and I think that's probably one of the reasons you don't see it used by multiple smaller businesses. You need to have the credibility and financial security to be able to underwrite it over a 10-year period for both us and the insurer needs to have confidence over that time. It works off the production, ABARES production figure in Australia. At a below average crop, we can get paid up to 80 million in an annual period by the insurer. And that, as I said, protects our balance sheet and covers fixed costs and is valuable in that respect. In bigger years, we need to pay out up to 70 million. And we've done that over the last number of years. And we're delighted with that outcome because we've demonstrated in our earnings, which includes those payments, that we're more than able to afford that. And the benefits are much greater than that. We've now reached a cap on the product. It's a net cap. So over the next 4 years, the remaining life of it, we're not required to pay any more, but the insurer could pay us if we were to go into a drought period. Of course, like everyone in the room, I'm sure we're not asking for a drought period. We're not predicting it. We certainly hope it doesn't happen. So that's how the product works. And in that respect, it's worked well. Just rounding it off, would we renew it at the end of 4 years? Premature and hypothetical because, it would come down to what the conditions were at that stage. But I think more broadly, it's unlikely we would, given we've grown the business, diversified the business, and have other ways of protecting the balance sheet through diversified earnings.
Question, great answer. Thank you, Rob. One up a minute.
You probably, as much as the Graincorp logo is beautiful, we'll go to the one with all of us having working together. There you go.
First question. Thank you. Now, any questions from the floor? It's very unusual to have the 4 leaders in the one room. And as you can see, Rob's with you there. We're very happy. Anthony.
Thank
You have a microphone coming your way.
Thanks for your presentation. One of the major changes we've seen over the last 4 years is massive on-farm infrastructure build, really on-farm storage, which is changing the supply chain dynamics. I'd just be really keen to get your perspective on how that will change your respective businesses or the opportunity with threat.
Start at the end because I think Graincorp's going to be in the gun here, but we'll.
Hello, Anthony. Welcome. A great question. I mentioned in my presentation I'd spent the first part of this week up through northern New South Wales. I spent quite a bit of time around Moree and made my way up north from there. Spent a lot of time on farm, visited some of our customers and saw firsthand some brand new infrastructure, some plans for infrastructure. It's really apparent, right? And I think we've all seen it. We've all felt it. It's a good thing, Anthony. Like it's clearly some of these customers getting bigger, some of these farmers getting bigger. There's consolidation happening. We know that. It's been mentioned a couple of times. There's an element of I'm not going to say distrust, but I think there's been some challenges on the supply chain in years gone by. So this is an opportunity to solve for that. There's liquidity in the market. There's been some a good phase in the cycle. For the most part, it hasn't been perfect in all geographies, but in some parts of the country, there's there's good liquidity in the market, and it's as good a place as you need to put your capital, some on-farm storage, whether it's fertiliser, chemical sheds, grain silos, or whatever the case may be. But the infrastructure going in is really apparent. I think generally it's a good thing for the industry, but let me pass it down the other end.
I would say from our perspective, it does give us access to grain in grain silos over a longer period. Obviously reduces the intensity to some degree during the harvest, and I suppose it gives the farmers a bit more resilience. So yeah, I think there's a sweet spot for an individual farm to make that decision, but from our business perspective, it's given a bit more option.
Yeah, likewise, we see a role for on-farm storage. Graincorp's got no value to add in being in the middle of a delivery from a farm to the feedlot up the road. So I think on-farm storage comes into its own in that part of the domestic market in particular. The second thing I would say is that increasingly we're seeing farmers modify the way they use their on-farm storage, and they really are using it as a harvest tool. Harvesting has become quicker, bigger equipment, faster over recent years, and that trend continues. Even truck sizes, I think, have increased 16% over the last 5 years. So by utilising on-farm storage during the harvest period and then ultimately delivering into our network or even direct to our ports, we're still seeing that grain, because the reality is on-farm storage doesn't get your grain to the end customer in Thailand or Vietnam or Indonesia or China or wherever else it may go. So, it can be very useful as a tool like that. And, ultimately, farmers are making decisions around how long they want to keep that grain before they're up for the storage and handling costs associated with keeping it on farm as well. And the scale of our network provides some real efficiencies and economies in that. And we've adjusted our pricing to make sure that farmers recognise that value, which is maintaining the relevance of the bulk network, which is really important when you look at Australia's competitiveness going to the world. And it's been nice to get commentary back from farms around how efficient and competitive Graincorp has been in our pricing and the way we think about that. Thanks, Anthony.
And we might go Steve, then Andrew.
Thank you. Trust is a critical element of doing business here in Australia and global markets. As you go into markets overseas, what value do you think they're putting on the fact that you can trust Australia to deliver, not to put tariffs on products? But is there a real sort of backlash at the moment in terms of the inability to trust America as a reliable supplier of grain versus how you're perceived overseas?
I'm sure I'll rely on my colleagues for their sectors as well, but look, I'm not going to comment on tariffs, particularly because I haven't looked at the news in the last 20 minutes, and who knows, it might have changed, so I might be out of date. It is very volatile, but the reason I say that is not to be flippant, but to emphasise the fact that food products are incredibly resilient because people need to eat. So whilst tariffs, food products may not be immune from tariffs, the demand will still be there, and the impact is more economical rather than on demand or volumes. In answer to your question, though, my experience is customers of Australia, so countries that we trade with, really value the stable governance that we have here, our reliability over time. And when it comes to food, they value the reliability of service, but also the quality. And I think that's something that we should be really proud of as a sector, not just from what's produced on farm, but how we handle that right through to end customer. And last week I was up in Thailand. We had a bulk vessel on charter, 62,000 tonnes of wheat that was being unloaded off the coast of Thailand, and we took some customers and partners out to have a look at that being unloaded. And it really demonstrated the efficiency of what we do. But even in Thailand, there was the SGS crew there that were measuring the quality of the grain. And it's that sort of thing that's valued by customers. Now, can we see the price in that, on a per tonne basis in every shipment? That's harder to argue. But does it mean those customers are there for us in the long run? Does it mean we have strong relationships and ultimately can get a premium and compete against other markets? Absolutely.
Look, I think it's a really important question. If I put my sort of agribusiness hat on it, it's central to a lot of the discussions around ESG, to be honest. How do you create a sustainable competitive advantage? It's not just doing it, it's doing it authentically and then being able to be accountable for the claims that you're making. So there are a whole sort of series of things that then fall underneath that. It's what standards we would like to propose that that we establish as an industry. Individual companies then can build on that to create a competitive advantage, to engender trust in their product. It's a little bit more trustworthy, and it's got attributes that you can rely on. And then there's the whole supply chain integrity and the data that flows up and down the supply chain to support those claims that consumers build trust on the products that they're consuming. And particularly when we move into less tangible, less product specific attributes, it's the way it's produced, the process, it's the way that the natural resources are used to produce it. So there's a really interesting question around supply chain integrity, data management, communication, and ownership, I think.
I'll just add one more thing. I think the other really good example to think about is beef exports and what Australia's been able to do there. It's just brilliant. I mean, the reliability we've got in the supply chain now, notwithstanding some of the domestic challenges, labour and processing capacity, etc. But putting that aside, the reliability, the high quality, the reputation that we've got now in global markets for that. There's other dynamics at play as well. Currency, we haven't talked a lot about that, but a weak Aussie dollar suddenly makes us a lot more attractive. But then we can get into the input costs, which predominantly we import as well and are foreign denominated as well. So there's a lot of factors at play, but I do think, crop inside, grain production, fantastic. Also livestock, beef, really good example of where we're doing well.
Thanks. I'm interested in the panel's perspective on, you've all got return on capital objectives, but you've also got sustainability objectives. Europe's driving the sustainability also across the world, yet you've got Trump on the other side, who might be slowing things down. When you're thinking about your sustainability projects or allocation of resources, how are you sort of thinking about the speed at which things are going to move today, for example?
I'll start. Yeah, I mean, there's license to operate type investments that we will make, as all companies will make, I guess. And that, I think that's the absolute baseline. That's the starting point. But increasingly, we're looking at through a lens of how can we commercialise some of the good things that we're doing. I think you've heard that in one way or another from just about everyone that's spoken so far. And I'd imagine you'll hear more of it this afternoon. But it's around what products can you bring to market, what solutions, what practices can you bring to market. If you start with a customer lens, how can you help them monetize that? How can you help them tap into some of those value pools that are going to be created? That's where we start from. And then we move backwards from there all the way back to the practices that we do as a company and the way we report those practices. But like everyone, we're looking for the creation of those value pools and how that's going to play out in the market. But I'll let these gentlemen add to that.
Perhaps I'll reflect on a question that Paul asked me when I was up at the lectern there before about Elders' investment in sustainability. And we're an organisation like Nutrien that invests in a lot of different services to farmers. That sustainability sits very comfortably within our organisation, I think, because it allows us to look at a whole farm perspective and help farmers manage the trade-offs. Where is the productivity benefit? Can I report that there's been a sustainability sort of benefit as well? If I have to meet some sort of standard, it's going to come at a cost. How can I offset that, or how can I integrate it into some sort of productivity gain? So I think from our point of view,
I think it's an interesting area, but sits well within an organisation that's providing a multitude of services.
Yeah, and I would say within our business, from a product point of view, we operate in the middle of the supply chain, and so to a large degree, it's about servicing our customers' demand requirements. And there's no doubt the consumers has increasing expectations, and so how can we deliver solutions that are viable for that demand? So that's on a product side. On the broader ESG components, gender equity and making sure that we're accessing a broader, diverse pool, that just makes good business sense for us. We're in a sector that is underrepresented, particularly from a female perspective, and even today, and we're missing out on the opportunities to diversify the skill set that we need.
I'll try not to be repetitive, but I think if you break it down into the various stakeholder groups, that makes it easy to prioritise and make decisions. That might be what customers want, might be what shareholders want, might be what you need to do to get access to capital, both from shareholders. I can see some bankers in the room nodding around sustainably linked finance. So, there's those aspects of it. From a timing point of view, it's fair to say we're focused on those that are good for business in the near term. Reducing energy usage usually has a cost benefit and a sustainability benefit. And then over the longer term, that will become even more true as high emitting energy use costs go up and regulation comes to bear as well. So setting yourself up for the future gives you that economic return is the way we look at it. And just finally, I think if it's in that context, if it's sustainable, it'll be good for business. And if it's good for business, it's going to be sustainable. So that's the way you've got to think about it.
Carmel?
Hello, thank you for the presentations, Carmel Williams, Commonwealth Bank. Just to stay on the theme of sustainability, I imagine that there's a whole bunch of new capabilities that are being required in some unusual areas. For example, one of the emerging themes we're starting to hear a lot more about is the activation of the health sector around the way food is produced and the link between production and human health. And I was curious just to understand a little bit about the challenges of finding the right capabilities to assist your strategies in sustainability and how you're thinking about building those.
Well, just very briefly, I think it's partly what you do in your own business in terms of accessing those expertise, but also it's an area where collaboration does come together at a pre-competitive level. Mark spoke about Agribusiness Australia as just one of many examples of the sorts of forums that we lean on to get more accelerated and greater capability than we can achieve ourselves.
Just on the nutrition, I'm interested in the nutrition side. Is anyone able to comment there as to the link between, I suppose, preventative health that occurs right at the farmer level? And the scary stat is in Australia, we spend, I think, 1.3% of our money on preventative health and 99% on when people get sick. They're half of the GDP, or half of the OECD level. But, maybe with your international hat, Adrian, you can talk about what Nutrien is doing potentially.
Yeah, I mean, I'll have a go. And it's a great question because you're sort of touching on the practices, the talent pool that we've got to access the innovation that's in the market. And it's, there's no easy answer to that. But I guess what I'd say is there is some excitement around the pipeline of solutions that are coming. So whether that is animal health type products and the types of products that can play a role, methane management is going to be a particular thing on the livestock side that I think will be really meaningful into the future and the way we feed. And actually, it's a conversation that's real. I mean, I was on a feed lot just outside of Gundawindi, probably yesterday, actually, maybe 2 days ago, and talking to the three operators, and they were, the last people you would think would be able to have a conversation about sustainability and sustainable practices in animal health and what they were doing. So we spent the first part of the conversation talking about expansion plans in the US, and I thought, dare I say it, I'm going to enter the sustainability conversation with these fairly rough-looking blokes, and they were right into it. You know, they were into, hey, this is what we can do with the cropping that we're doing to feed them, and this is what we're doing around trialling some of the new feed additives. This is what we're doing around supplements. This is what we're doing around the health of the animals and how we're prioritising that. So it is exciting, it is real, it is being talked about, and sometimes it's the people you perhaps don't expect to be that engaged in it that are incredibly engaged. I was really impressed. Yeah.
I might just add that a lot of the requirements are coming through from grocery chains, and obviously, you know, their requirements will protect consumers, and then through the likes of the QSRs, quick service restaurants, and their procurement requirements. So it's common for us to be audited as part of our customers' supply chain, who are then servicing the grocery or QSR restaurants. So as a result of that, we're having to comply and adapt to that requirements. But you know, I think it's not so much a technology or capability point of view. It's the repeatability and the controls are the key aspects. I mean, clearly there's antibiotic controls and all of those kind of aspects, and you know, there's a whole regulatory environment around that. But and you know, I wouldn't say I've experienced that ramping up. That's been a decade. We've had all of those controls.
Last quick question.
Sure. Thank you for the panel. Carly True, so we commercialise a crop called barley max in Australia, discovered by the CSIRO. So very, very high nutritional value. So a bit more of an esoteric question. In 2040, do you see a point where we can do more value-added commodities instead of in bulk, getting to a more high value chain? What are your thoughts on that?
I'll make it 2030.
2030.
Yeah, 2030.
Look, you know, I think that's happening. Graincorp's strategic focus on additional processing is around more value add in Australia. But if you look just at a basic commodity level, growth of the product, soft commodities that we handle over a 30-year period averages on a compound annual basis about 2.7%. And that's on a very consistent and similar planted area. So you're seeing technology and innovation improve productivity. That, you know, improves value as well, better utilisation of land, water, and other things. And then, you know, further processing and investment drives us further down the value chain. So very much front and centre in our strategy.
Okay, thank you very much for the question. And also, you know, the questions from Adrian, Carmel, and Steve remind me to talk about CBA, which has been a great sponsor of this conference the last 4 years, and they've got a lot of their relationship managers in here, and you can see that from the questioning and the way they're engaged with their customers, it's fantastic. So, and thank you, the panel here, Adrian, Mark, Quinton, and Rob. I think it's been a fantastic second session. As I said, we've got the leaders here. We can really ask the tough questions about M&A, but maybe we can do that over lunch. And look forward to the next session, because there is a bit of M&A in the dairy sector that we might be able to touch on. Thank you.
Good, thank you. How you going? That was it, by the way, wasn't it?